Stocks to rally as inflation fears subside. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of Heise Says US. Grab your stein, let's have a look at this article from CNBC discussing, subsiding inflation fears, or markets no longer fear inflation and stocks will continue to rally. Let's have a look and see if this is true. So, markets no longer fear inflation and now focused on the spread of the Delta COVID-19 variant, according to HSBC Wealth Management. In a note Thursday, Chief Investment Officer Zane Chan said that after a period of concern about persistent higher inflation, with investors assessing whether the US Federal Reserve may be forced to tighten monetary policy, markets appear to have gotten used to the concept. He pointed out that while US consumer price inflation remained high at an annual 5.4% in July, the 10-year US Treasury yield has declined, indicating that markets have nothing to fear but fear itself when it comes to inflation. This is normally there is normally a direct relationship between bond yields and inflation expectation. If inflation is expected to be higher, then bond yields go up to reflect the likelihood of higher interest rates. But increasingly, bond yields have come down after peaking in April, he said. As of Friday morning in Europe, the 10-year Treasury yield dropped again to 1.3405%, having been above 1.7% in March. HSBC forecasts that it will fall as low as 1% by the end of the year. Meanwhile, the S&P 500 notched a new record high on Thursday, and he highlighted that their market moves are occurring despite inflation expectations remaining elevated. The Philadelphia Fed's ongoing survey of forecasters indicates the consensus expectation for inflation to run at 2.4% over the next 5 years. Even when analyzing stock market volatility, upon closer inspection, the S&P 500 has still pushed higher month on month since January, despite concerns around inflation. Even May and June, when inflation fears were highest, delivered positive returns, he said, adding that this has all suggested financial markets are no longer afraid of higher inflation. He noted that this does not necessarily mean investors will not get spooked by messaging on the Fed's intention to taper its quantitative easing program, but said the Fed had thus far managed to its tapering communications pretty well. Arguably, markets are now more focused on the state of play regarding COVID and in particular the spread of the Delta variant, he said. COVID case numbers are rising again in various parts of the world, with several countries, most notably in Asia Pacific, reintroducing containment measures in recent weeks. Meanwhile, the UK and others have forged ahead with reopening their economies. But regardless of where you look, the general view and hope is the broad success of vaccination programs will allow the recovery to continue in H2 this year, he said. It is on this base case that HSBC is still investing in equities, particularly in sectors directly exposed to consumers, such as consumer discretionary, financials, and real estate. However, he cautioned investors that volatility may still pop up periodically. Strategists at the major banks are split on the outlook for the second quarter, however. Bank of America head of European equity strategy, Sebastian Reidler, told CNBC Pro Talks earlier this week that as growth moderates, the reopening boom fades, and stimulus from government and central banks is unwound, stock markets will all lose steam. I think we have seen very clearly the peak of the global cycle and the euro area cycle at the end of the second quarter. And in very simple terms, if you are now decelerating instead of accelerating, then you are really starting to lose the key catalyst from this fantastic equity market performance that you have seen over the last 15 months, he said. So there we go, everyone. Predictions, two counter arguments. One, that the market is all going to continue rising, and the other, that we've run out of steam. What do you think? What's the takeaway or the solution to this? Well, here's the question, everyone. If you're getting two strategists, two banks, two groups put two different arguments on the table, how do you respond? Have you invested in the US market? I'm not going to jump at a solution or pull one out. Maybe hedge your bets, play both. The best thing I would suggest, and what I'm frankly doing, is have a diversity of investments to ensure that any corrections you can handle. Last few times that the markets, dipped a bit, been a little bit upset. I'm investing for the long term. I'm a long-term dividend investor at the moment. That's where I'm putting all my US investments in. So I'm not too worried. We'll see how it all goes. What are your suggestions, everyone? Let us know in the comments down below. Thank you all for watching. Please like, share, subscribe to the channel. If you're a fan and enjoy the content I cobble together here, there are a few ways you can support us. You can join us on YouTube or Patreon, sign up for Self-Wealth or Stake, use our affiliate links from Amazon, eBay, Independent Reserve, or Aussie Broadband, buy merch from Heise Says, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. I'll see you next time. Bye for now.